Welcome back, everybody, to another episode of Main Street Money, where Wall Street meets Main Street. I'm Andrew Gay.
And I'm Gilbert Paiz.
As always, our goal here is simple. We take what's happening in the markets, the economy, and the world of financial planning and translate it into something useful for everyday investors. Now, we're recording this while the markets are still open this Friday afternoon, so some of the numbers may move around a little bit before the closing bell. But assuming markets finish roughly where they are now, this week's story wasn't really about stock prices. It wasn't even really about the Federal Reserve. It was about the economy. This week, we received some of the most closely watched inflation and consumer spending reports of the month, and together they painted a picture of the economy that continues to surprise people with its resilience. The question investors are asking now is simple. If consumers continue spending, businesses continue hiring, and corporate profits remain strong, how quickly does the Federal Reserve really need to lower interest rates? Let's jump right in. Segment 1, the market continues to climb. Assuming markets finish near where they are at right now, we're looking at another constructive week for investors. The S&P 500 remains near record highs. The NASDAQ continues trading above 26,000. The Dow remains above 51,000. Even with all the headlines surrounding inflation, geopolitics, the interest rates, markets continue showing impressive resilience. Year to date, all three major indexes remain solidly positive. One thing that has really impressed me is how broad this rally has become. We're seeing participation from technology, financials, industrials, and communication services, and several other sectors. That's generally what you want to see in a healthy market. Gilbert, let me ask you this. When clients see markets continuing to climb despite all the uncertainty and headlines, what do you think surprises them the most, and what do we usually tell them?
Well, I think the thing that surprises clients the most, especially after the market's been on this upward trajectory for the past, not just year to date, but the past 3 years.
Yeah, going on 4.
They can be very surprised when the market goes back down again.
Markets don't wait for uncertainty to disappear. In fact, history shows they often begin moving higher long before headlines improve. That's why successful investing usually rewards patience and discipline more than perfect timing. Segment 2, inflation, spending, and the Fed. This week's biggest economic reports were the Personal Consumption Expenditures Report, or the PCE inflation, along with personal income and consumer spending. Now, the PCE is the Federal Reserve's preferred measure of inflation. Headline PCE inflation came in around 4.1% year over year. Core PCE remained around 3.4%, still above the Fed's long-term 2% target. At the same time, personal income increased by roughly 0.7%. Along with consumer spending, that also increased about 0.7%. That's telling us something important. Consumers are still spending, businesses are still selling products and services, and the economy continues moving forward despite higher interest rates. So, Gilbert, when you look at these reports together, higher inflation, stronger consumer spending, and rising personal income, what do you think they're telling us about the overall health of the economy?
Well, I think it's telling you that the economy is still very strong and the consumer still has gas left in the tank.
Yeah. And yes, I agree. The economy isn't sending one simple message either. It's saying growth remains positive, consumers remain resilient, inflation remains elevated. All three of those things can exist at the same time. That's also why the Federal Reserve continues taking a patient approach. If inflation remains sticky and consumers continue spending, policymakers don't simply have much urgency to lower interest rates. Segment 3, profits still drive stock prices. Now, despite all the attention surrounding inflation and interest rates, let's not lose sight of what ultimately drives stock prices: corporate earnings. Current estimates continue to show S&P 500 companies tracking roughly 25 to 28% year-over-year earnings growth, and that is exceptionally strong. Technology continues leading the way with ongoing investment in artificial intelligence, cloud computing, semiconductors, and data center infrastructure. But what I find encouraging is that an earnings strength isn't limited to technology anymore. Financial companies continue reporting solid results. Industrials remain healthy. Communication services continue performing well. Broad participation is generally a sign of a healthy bull market. Investors hear so much about the Fed, inflation, elections, geopolitical events. How do you help clients remember that at the end of the day, corporate earnings are still what ultimately drives stock prices, Gilbert?
Well, you know, it's sometimes tricky because it can sometimes feel like stock prices, especially in technology and in particular AI companies, some of their stock variations can become unattached from fundamentals.
Yes.
And that's sometimes really, really tricky to manage, because as human beings, we think stock prices will just continue to do what they're doing today, which is just go straight up. And that's
Right.
not the way it always works.
It's a lot easier said than done when it comes to saying, I understand that, versus sticking with a disciplined plan. Maybe it feels like the sky is falling, right?
For sure.
So politics matter, the Fed matters, inflation matters, but over long periods of time, profitable businesses tend to reward long-term investors. That's why we encourage clients to focus on fundamentals rather than reacting to every headline. Segment 4, Financial Planning Corner. Purchasing power may be the biggest. So every week we try to connect what's happening in the financial markets to a real-world financial planning concept. This week I want to talk about purchasing power. When most people hear the word inflation, they think about higher grocery bills or paying more at the gas pump, but inflation affects something much bigger than that. It affects what your retirement income will actually buy over time. 3 or 4% inflation may not sound dramatic, but over a retirement that could last 25 or even 30 years, those increases compound significantly. That's why retirement planning isn't simply about preserving today's dollars. It's about preserving tomorrow's lifestyle. So Gilbert, let me ask you this. When we're meeting with retirees, what do you think concerns them more over the long run? Short-term market volatility or the slow erosion of purchasing power from inflation?
I think it's the short-term market volatility, because again,
I would agree.
People tend to think that what's happening today will just continue. And so whether we're on an upswing or a downswing, especially with the downswings though, people tend to think, well, this is what's going to happen forever. And my retirement account is going to go down and down and down forever, and I'm going to have nothing.
And they can see the number.
Yes.
Right. So it's almost like it's a tangible thing, where the slow erosion of purchasing power is like almost an invisible thing.
That's right. It's not something they get a statement on every single month.
Right. Right. So cash has a role, high quality bonds have a role, but most retirees still need some long-term growth because inflation never really retires. That's one reason we spend so much time talking about diversification. Some investments are designed to provide stability. Some are designed to provide income. Others help provide long-term growth that can outpace inflation. The goal isn't simply achieving the highest return. The goal is creating a portfolio that supports your lifestyle through changing markets, changing interest rates, and changing economic environments. Segment 5. So let's wrap this up. This week's reports reinforce something we've been talking about now for months. The economy remains resilient. Consumers continue spending, personal incomes continue growing, corporate earnings remain strong, inflation remains above the Federal Reserve's 2% target, and that likely means interest rates could remain elevated longer than many investors expected previously. Gilbert, if you had one message for investors after this week's economic reports, what would it be?
Always think about your allocation and whether or not your allocation is sufficient to keep up with inflation.
I couldn't agree more. If there's one takeaway from this week, it's this: don't build your investment strategy around one inflation report, one Federal Reserve meeting, or 1 week's worth of headlines. Build it around your long-term goals. Markets will change, interest rates will change, economic reports will change, but a disciplined financial plan designed around your objectives shouldn't have to change every time the news cycle does. Gilbert, thank you as always for joining me. Thank you guys for joining us for another episode of Main Street Money. You can find us online at texashillcountryadvisors.com. Follow us on Facebook, LinkedIn, and YouTube, or Spotify. Thank you guys very much. Have a great weekend. We'll catch you back here next week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.